So thanks for joining us for another live with Brent and Lee on this Wednesday night. If this is the first time you've been to my channel, my name is Lee Brickey, and on this channel we talk everything real estate in Palm Beach County and the Treasure Coast, and we do it with our good friend on Wednesday night, Brent Starts from Unitas Lending. So let's get started. Tonight we're going to talk about what's going on with the Fed and the new CPI report, why the stock market took a crash yesterday, what that means for the market, what that means for rates. And then we're going to tie it all into the Florida market and what's happening here. And we'll tell you a little bit what's happening with us with boots on the ground, because I have been out showing property with my team. And then we will also give you guys an update on the August numbers for Port St. Lucie, Martin County, and the Palm Beaches. So if you're interested in any of that, stay tuned, because that is what we're talking about tonight. So how you doing tonight, Brent?
I'm doing great, Lee. How are you?
I'm doing good, man. Just tired today.
Long day, huh? Running,
long
folks?
Day, running all day long. Hey, man, you know, we've been able to show more than one house at a time here lately. So it's actually a great thing. So,
right.
So,
here's the house that's available.
Right. Here's the one house that fits your criteria, maybe. And
right.
No, we were able to, we've been able to actually show, multiple houses, and it's a little bit less craziness going on. So that's good. And so if you're, tell us where you're coming from, where you're watching from, if you are, and come with any of your questions and concerns, and we will answer them for you. So let's get started, Brent. Where are we getting started tonight?
Wow, the big news of the week, probably CPI. I imagine you have a screen on that, or
yeah, I got a screen on that, man.
Yeah, that was the big news yesterday. Yeah,
U.S. inflation. I guess it's kind of good news, right? It fell a little bit from 9.1 in June to 8.3 here, but I don't think anybody's really filling that in their pocketbook right now.
Right. Well, I think, this is a thing, Lee. It's all about expectations, right? I mean, what really did that was the inflation figures. They were expecting the month over month to drop 0.1%, and it went up 0.1%. So we're literally talking about 0.2% difference in what was expected. And that's where we run into problems. The market is so hypersensitive right now to this data, because the inflation is going to be the driver of the Fed's decisions, here on September 21st, and the upcoming meetings throughout the remainder of the year as well. So when there's a miss like that, even though it's a really, technically it's a very small miss, that's not a big miss.
Right.
However, when you take it out yearly, though, then, we're looking at, 2.4% if you're off 0.2 every month, if you do the math for a whole year. So it's really, not that big of a miss. But when everyone's as sensitive they are, it really hit the markets yesterday. I saw the Dow was down almost 1,400 points at one point, and closed down over 1,200. So it was a big hit that day to the stock market and the bond market. So that's, it's funny. We on Monday we put out on our channel we put out a market minute, and on Monday I said, hey, if you can't afford a rate hike, what I mean, if your DTI is close, lock on ahead of those reports, because it wasn't just CPI but PPI came out, producer price index came out today, and it came in pretty much as expected. So it was a non-event technically, but yeah, it's on those big line items. The jobs market's another one, comes out the first Friday of the following month for the previous month's job figures. That's another one you want to get ahead of, and if you're close to closing, you want to lock before that report comes out to remove that risk off the table.
Right.
Yeah.
Right. So where are we sitting at with rates right now, man?
Yeah, the average, Freddie Mac puts out a weekly report, and so we tipped into the 6% range for the first time in 14 years yesterday. Today, the markets were still trying to stabilize this morning after the bloodbath yesterday, and even though the report was pretty much as expected, the market still sold off, and so bonds were struggling. Rates were up a tick this morning, and then they started to crawl back, and so they came back down. They settled right around. We were quoting rates at, I think we quoted a couple deals in 30-year fixed, 20% down, kind of standard credit at the 5.8, but 5.85, but nationally they're over 6 right now.
Right. So, I mean, this is showing rates at 6.3% yesterday.
Yeah, that's where they spiked out. It came back a little bit, improved a little bit later on in the day, and that's nationally, and most banks are in that territory right now. We get reports from the Mortgage Bankers Association. Well, so we kind of know what the competition is doing. The mortgage banking industry is a little different than the brokerage community. Little layers of overhead that we don't have, and things like that. So they're, you call Chase, you call Wells Fargo right now, they're in the 6 1/4, 6 3/8 range. Yeah.
Right. Yeah. So, where do you think we're going here, man? I mean, the Fed's, the market's talking about, 75% of the market's talking about 100% basis points increase.
Yeah. Lee, I'll tell you what, and this has been our stance for really the last, 4 or 5 months is, we're going to see, rates go up. We were locking long-term 5, 6 months ago, and we closed up a bunch of those loans, with a lot of happy customers because,
Right.
it really made sense, even though at the time it seemed like a high rate because we were closing, locking rates 3/8, almost a half point higher than market at the time. But in June, July, we were heroes because of it. So, but I think what we're seeing, you have to parse the data and dig into it a little further. One of the things that's really important to understand, and no one's really talking about it too awful much, is that what came out today, the producer's price index. And what that is, that's the cost of raw materials to make consumer goods, right? So, those types of materials, metals, plastics, those types of things, raw materials are used for production. What's happening to their prices? Because what happens, that's a leading indicator of where inflation is going to go, because that is passed on to the, producers of the actual end products, the consumer goods, right? And then that's passed on to the consumer, and it's reflected in the CPI, the consumer price index, the price that they're buying those items at. So, the good news today is, and it was a non-event, but I think it's pretty significant. The yearly, dropped from 9.8% to like 8.6%. The
Right.
year over year, wholesale production. So what's happening is, last summer is when we had some really heavy inflation numbers for a producer price index. May, June, July, August. Those numbers were high in 2021, the summer of 2021. Well, then we started to see September, October, November. We started seeing 0.8, 0.9 reads month to month in CPI. It's a lagging, statistic. It comes, CPI's hit, 3 or 4 months later, right, when those goods are, produced and then sold. So, we're seeing those greater numbers fall off. That's why you saw a big drop in the year over year between July and August on PPI today. So those big figures are dropping off from 12 months ago. And we're seeing, if you look really close to the data, the month to month, in October, we're going to lose a 0.9% month over month. If you remember last fall, inflation started to become a topic, and everyone was starting to talk about how it's transitory, right?
Right.
Remember that?
Mm-hmm.
And so we're October, November, those 2 months, we're going to knock off a 0.9 and a 0.8 month over month. So those are going to be taken off the year over year statistic. You know what I'm saying? Those figures. So we'll see that, so we should see a drop in October and certainly November on the CPI. So we'll be seeing that kind of capping out. And that's when I think the Fed's going to, lift up on the gas a little bit. But Lee, they're talking about, full point at the 21st meeting. That's on the table.
Right.
So, yeah.
Right. Do you think that's baked in already to the mortgage rates, though?
I think it is. The 75 basis points, pretty much a foregone conclusion, right? Unless there's something that happens just out of left field in the next 7 or 8 days. The Fed goes silent the week before the Fed meeting, so they're not going to talk the remainder of this week and into next. So we're not going to get any, feeling from, the Fed governors as they speak at different councils and things that they do to kind of telegraph what they're going to do. That's done very purposely, by the way.
Right.
And, to kind of to not shock the market. But they're going to be silent. It's going to be data driven. So I think, with the figures on the CPI and the reaction of the market, I think, the 75 basis points baked in, I think there's a chance that they could do a full point, 100 basis points, which is 1 full percentage point to the Fed funds rate. And if they do that, I think that the markets may like it because there's a response to it, which sounds kind of strange. But we'll see what the data looks like this coming week. We got retail sales coming out tomorrow, and consumer sentiment coming out on Friday. So that'll be are people feeling like buying right now? What's the consumer sentiment? That's a pretty big figure that's going to come out Friday. Then
right.
What
do you expect on that one?
They're looking for a less hopeful consumer out there.
Right. I think they got that already. I mean,
I think so. Don't you think? I mean,
I think we live we're in a bubble here, but other places people are not buying anything.
Right. I think people are starting to hang on to their money, and hey,
right.
And I think it's a decision everyone has to make. There are people that we work with that their jobs are very secure. And the employment situation obviously is different here in Florida than it is in the rest of the nation. So it's a case by case. People need to make their own decisions. Obviously, their own situation's unique, but I think we're not going to see the hit certainly in jobs here. It's just not happening. Certainly no sign of it yet.
Well, I was listening to the BlackRock CEO. They're putting in that 5,000 square foot facility in City Place in West Palm Beach. But I was listening to the BlackRock CEO the other day, and he was talking about this 6 months ago. This is coming.
Right.
The fact that the Feds pumped so much money and the federal government pumped so much money into the market and just kept pumping it in, and then on top of that dropped rates to 0%, and then we saw mortgage rates as low as 2.25%, right?
Right.
15-year, and then now we cut back on oil and gas production. He called this 6 months ago. It's just going to get out of control and start to spiral out.
Oh, absolutely. I mean, you can't print $4 trillion and expect, not to see some ramifications of that,
Right.
And when they were talking about being transitory, the markets were really kind of bucking that. It's like, what? That's just not, it's going to show up in the market. It's going to show up. And then the market almost liked it when they started raising rates in June, or excuse me, January this year, because, they think, hey, we're kind of late to the game. Now we got Europe, that they're about 2 months behind us. And boy, what's going on there?
It's bad. They're burning coal again.
Oh my goodness. They were negative rates, and what I mean? Right. And now they're in a situation where they're popping some, strong, European central bank is just really going to, they're buying, they're selling off the assets off their balance sheet as well.
Right.
So, so that's reducing, supply, it's a real serious problem there.
Yeah. So, I mean, Russia cutting them off from oil and gas completely is destroying them.
Oh, they're up 200% since June on natural gas. And they say it could be 5 times the price this
9
winter.
over in Europe. They're saying 4 times here, 9 in winter. So Nicholas, through a question, does the potential railroad strike have any effect on the Fed's meeting next week? What do you think?
You know what? I think it could be a supply chain issue, that could cause some problems. Absolutely.
It's definitely going to cause problems in the oil and gas industry, because there are railroads where oil's coming down from Canada to Houston.
Yeah, right. And when they stop the construction of that pipeline, that's wondered if the railroad lobby had something to do with that.
Go look at the money given to the administration. You'll figure that one out real quick.
I think I've heard that too. Yeah.
So
crazy how things work, right?
I know. But
crazy.
So anyways, Nicholas sent me an email today I hope I answered your question well. And I'll just cover that real quick on these new construction homes. These builders, he sent me an email today on about builders, and that What is the, should he get a inspection as the builder builds? These builders don't like that. They're not gonna let you do it. It slows down their build. So GL Homes, I don't talk a lot about them because of I just don't think they do business well, and they haven't done a good job through I think they've really, I don't know, done a kind of a bad job of taking care of their clients and through this whole 2-year boom that we saw. So things are starting to calm down, but GL is a good builder. I mean, they've sold a lot of their homes, and they have a lot of communities in Boynton Beach. So they're a good builder, but listen, just stay away from Lennar and Ryan Homes. And there you go. I said it.
Right. People want good information, Leah, and that's what
so
I know.
I said it. So there it is. Go look at the consumer, and it's just just not.
Just look at the reviews. Reviews kind of give you an idea what's going on out there. Yeah.
Good question. Why is GL the home only builder that's not seeing they are seeing the decline in sales? They're so backed up in building where they're 14, 15 months out on the build right now, where like Mattamy, they're 8 to 12 months. The Pulte, same thing. So they're starting to see the traffic slow down, and they they're seeing the same thing everybody else is seeing, and so they're going to have to conform to eventually you'll start seeing them start throwing out the big concessions like everybody else is. They just have so many people in the pipeline right now, and they're so backed up. So yeah, Nicholas, here it is right here, man. It's 15 to 18 months. Doesn't take them 15 to 18 months to build a house. It's because they're so behind right now, and because they oversold the community. And I think that lottery acquit. I mean, Minto here in West Palm Beach at Westlake, they're no longer on a list anymore, and Coulter selling homes now too. So Alton here in Palm Beach Gardens, they're no longer on a list. I'm pretty sure PJ Verano now they have models to sell, so a new construction. So all the builders are pretty much starting to see the slowdown in the market, but I think we're going to see a little bit of a bounce back too, though, because the market is starting to pick up. I'm starting to see properties go under contract. Matter of fact, one that we were going to look at today went under contract this morning. So, and that's $1.3 million property here in Jupiter. So it is starting to happen. But good question. Thanks a lot, Joseph, for that. That's a good question. So, getting back to keep bringing the questions. We'll keep answering them, but getting back to some slides here. You're seeing a lot of this right now. The Fed could crash the housing market, and that's what my title was today. And we really want to talk about this because, it's my opinion, Brent. I don't think the Fed's going to do it.
No, I think
the housing market start to collapse. They're going to back down.
Yeah,
because if they destroy, they just can't have the housing market collapse. They just can't do it.
Yeah, that's one of the things that lead us out of a recession.
Right?
Yeah, because housing's connected to so many other things, and I think that affordable housing is one of the cures to inflation too, because more disposable cash. I think they can't drive these things to the moon, and I think the market. Just as a side note, typically the 10-year Treasury gives us an idea. It doesn't set interest rates, right, to mortgages, but it's the most like a mortgage, right? It's a 10-year investment. It's fixed. It's relatively secure. It's secured by the federal government, right? So It's a secure investment. Mortgages are secured by real property in the U.S., which is the most favored real estate in the entire world. And so it is a good, solid investment worldwide, by the way, the investments in U.S. mortgages. So, you've got a situation where the 10-year Treasury in mid-June tapped on 3.5, right?
Right.
And this news comes out yesterday, and it swung it up to 3.53, and then dropped right down to 3.4. So the market's saying that the Treasury saying, hey, you know what? It's about, the Fed's done about as much as it's going to be able to do right now. Because just to look at what 6-8 months ago, the 10-year Treasury, to give you an idea, was at 1.6. So that's an enormous increase. And so when you have something that's more than doubled, it's likened to what happened, in the late 80s, early 80s, late 70s, early 80s, when interest rates doubled there as well. And you can only take that so far. That was an extreme situation. And I think, relatively speaking, they've accomplished pretty much the same thing as far as a percentage increase that reflects, of course, in housing payments and ultimately rents and affects disposable income and what people have left over at the end of the month to buy retail goods, to buy cars and all the other items that they need.
Right.
But they got to sort out housing. So I just don't think they can crash it.
Yeah, I think I listen to, you listen to the same people I do, different, we're both on, Keeping Current Matters. I like to listen to Jeb Smith out in California because he's got good insight, and his mortgage guy, they have their own show the same as we do. But Jeb, I think that, and Jeb brought this up a couple of weeks ago. I think that, the media is freaking people out and not taking into account that we're in a market where we're decelerating. We can't stay in a housing boom like this. Listen, there are certain markets I think that we're going to see some price dropping. The price is going to drop in some markets, and then we're going to see some markets flatten out. I mean, Jupiter is just stupid. What houses are going for here. And, it gets to a point where there's only so many people with the money to be able to buy them. And then the market starts to flatten out. And before COVID, we were seeing, the Palm Beaches, especially Jupiter Gardens, Wellington, Boca, Boynton, Delray, the hot markets. We were seeing those markets go to 3%, 5%, they were about 3%. And then other markets were at 5% in Palm Beach County. So we could see a flattening, I think, and that's because of the housing being so expensive and rates being so high. But we're still seeing property moving.
Absolutely.
And great question here. And I'll answer this one for you, Joseph. No, unfortunately, I've gotten a little bit of hot water with a few of my clients a few months ago when they started all these incentives, and I blew it out there. But no, they're unfortunately in the business of making money, and some of these builders are very greedy, and so they're not going to give you anything incentives now that they were giving that you've already signed a contract. But the good news here for you and everyone else that has bought new construction or in a contract with new construction, two things are happening. Number one, you've already had equity if you've been in it for a month. And the second thing is that you bought the house for less than you're buying it now. And even with the incentives, they're not going to drop prices. So that's why they're giving the incentives. I mean, we were out at Avenir today, and I mean, their Toll Brothers is up to I think $75,000 on some of their homes on incentives. They're giving away, they're doing free swimming pools right now. I mean, they're doing all kinds of stuff out there. So, they're going to do incentives to keep the prices up because the builders aren't going to drop prices, and they're speccing out homes. So again, Brent's explained this to you, to all of you guys, that a spec home is the builder builds the home, and if you get in there soon enough, you might be able to choose some of the options for the interior of the home, but the shell of the home is the base of the home is already chosen. And then once they get to a point, they're having their designers go in and pick things out. And that's happening right now. Cadence is opening tomorrow in Port St. Lucie and Tradition, and that whole community is going to be spec'd out. So you'll be able to choose your interior like you did at Emory, but you're not going to be able to choose the home and the lot. You'll be able to find the home you want and the lot. But good question, but unfortunately no. But again, you bought the house at a lower price. So at best, someone's buying it for what you bought it for at very best.
Very best.
They're not going to. Yeah,
I'd take the appreciation all day long over the incentive.
Oh, absolutely. I mean, so
yeah.
So that is that was a good question though.
That's a good question.
So, and then we're seeing this in Florida right now. So inventory depends on price tier, right? So we're seeing more and more inventory at the bigger numbers, $1 million and up, than we are at the lower price points. And then this is the entire state of Florida, by the way. So keep that in mind. Where we are from Port St. Lucie to Miami, every single market's different. So like the Orlando market, and every city in the Orlando market's different. Jacksonville market's different, and South Florida is definitely different, because we're seeing stuff in Miami selling for what condos in New York City are selling for, and they're selling it so fast. I mean, Miami's selling like crazy,
right?
And now we're starting to see property move here in northern Palm Beach County again, and Port St. Lucie is still doing well. And we're going to go over those numbers with you guys in just a minute, but this is this is definitely the rates are affecting the market, because it's causing everyone to lower what we're going to buy. So if you're buying a $600,000 house, now you're buying a $400,000 house. So is there a good rental market for new construction at 55 and over? I would stay out of HOAs right now with the rentals. But there's a great rental market in Florida right now. I mean, if you can buy cash right now, you're going to make a fortune. Or if you can find a home that you can Airbnb, like we sold one in Delray for $750, that home had turned $200,000 a year easy. I mean, you can make $10,000 a month on it without even blinking. I think you could do better than that. So, I know in Orlando, I mean, the Airbnbs there, some of these people are making $200,000-$300,000 off of Airbnb. So Delray, Jupiter, places that people want to visit. And then as far as the PSL market goes, long-term rentals, you're getting top dollar. We're not seeing anything come back down, because there's just no inventory.
I had 3 previous clients call me up this week alone, all wanting to buy homes for Airbnb. And because we're going into season here, if you're not familiar, so this is the prime season we're getting ready to rev up into.
Well, now Airbnb's moving year round.
Yeah.
I mean, like I have a friend of mine that has 7 in the Heights here in Jupiter, and they're rented all the time.
Wow.
I mean, he's making almost, I would say he's got to be making close to $1 million a year off those 7 houses. Wow. Because they're rented all the time. There's always somebody in them.
A little more management, but they have a system.
Well, I mean, you give it to the Airbnb and they do it for you. You just have, you have liability. You got to make sure you're putting them into a LLC, because, you're going to have more liability that way, because somebody could, trash a house, fall in the swimming pool and drown. I mean, there's all kinds of things that could happen, but it's depending on where you are in the higher, markets. I mean, somebody that's spending, $5,000 for a couple of weeks, isn't gonna more than likely they're not going to trash your house. So
not a bunch of kids looking to rip off a place,
setting up a party, so so it is. And then we're seeing market like this, housing market cools, home buyers regain leverage. So this is something that, you know, I really want to talk to everyone about, because, you know, there are deals to be made now. I mean, we're back to, hey, you know, new construction's giving all of these concessions. So when you're sitting down with a seller, you know, their home is, especially when you're up, you know, especially when you're up, you know, in the $700,000, $800,000, $900,000 range, you know, $1 million range. I think even like the $300,000, $400,000, and $500,000 range. I mean, I haven't been doing a lot of that lately, but I mean, there's concessions to be made. I mean, you can, you know, you can ask for concession for buying down your rate. I think that's way more important right now than paying your closing cost and your down payment. Is buy down, you know, get a concession to buy the rate down. But you know, it's nothing to ask for $10,000. You have your agent ask for a $10,000 concession to buy down the rate so that you can, you know, get some kind of reasonable rate. And if this keeps going on, we're going to start seeing owners holding the paper too, I think.
Oh yeah, if it gets, yeah. Oh yeah. I mean, that's how you bought a home in the early 80s. You
Right.
the seller carried the loan. You know, mortgages were 15 to 17%. So yeah.
Yep.
Yeah. Yeah. Lee, remember what was in 2019, 2020? We had concessions on every deal pretty much. You were negotiating for all your buyers, seller concessions as far as towards closing costs or buying the rate down. And, you know, it's going to be neat to see that come back in, because it lowers the cash required to close, which helps a lot of people out. So,
right.
Big advantage.
Yeah.
Yeah.
So, hey, tell us all about this, man. So all of the, what's happening here with the conforming loan limits?
Yeah, they're normally, you know, released sometime in November, but they knew what the percentage increase was as far as the median housing across the United States, and the formula is pretty much out. It's out of the bag, and so one by one, the investors were starting to release and actually accepting applications for the new conforming loan limits. You know, I just pulled a screenshot there. The Florida, these are all counties in Florida, and I just did a screenshot. Every county in Florida is the same. For one unit for single family homes, townhomes, condos, the $715,000 as opposed to the old figure was $647,000. So that's a big jump in conforming loan limit. I remember it was $152,000. It doesn't seem that long ago. You know, it's crazy to think $715,000. 2 units is $916,000. 3 is 1.1 million over, and then 1.376 for a 4 unit. So that new $715,000 conforming loan limit is going to help a lot of people. And why this is important: anything over $715,000 for a single family home is going to go into the jumbo market. So it requires a little more down. The rates are about anywhere between 1/4 to 3/8 higher typically on the interest rate. So lower rates and more affordability for those, you know, those homes in that price range. What we're seeing, you know, that $450 to $700 range is going to be more affordable. And you know, so it's that's a good thing. That's a good thing.
Answer this question, Brent.
Yeah, it's 50 on the closing costs on the 440 after 70 credit reasonable. It depends. You have your standard closing costs, and that if that includes prepaids, that's not too far off. If it includes prepaids, you know, that's, in other words, your prepaid taxes. Usually they're going to take about 4 months there, and they're going to take a full year of the insurance cost. And so, and their closing costs after 7. Well, we can look at that. And so it depends if you're buying the rate down too. I'd probably need to see like an itemized list of what those closing costs are, because a big variable in that could be, you know, an origination fee that's in part buying that rate down essentially. It's a sliding scale. So you've heard of no cost mortgages, that type of thing. Well, all the costs still are incurred. It's how they're paid. So, you can raise the rate, which, reduces closing costs, or you could lower that rate. And when you lower the rate, the closing costs overall go up. And what you'll see that is in the form of origination fee. It might be called a discount fee, which can be written off because it's essentially prepaid interest because you're buying the rate down. So I can't give tax advice, but that's how that's typically handled. You can talk to your accountant about that, but it's a sliding scale. So to answer the question, honestly, I'd probably need to see an itemized list.
Yeah, send Brent an email and he can answer, because buyers should shop for mortgages as rates rise. And these builders right now are bending over backwards to make sure their deals get closed.
Mm-hmm.
So, you don't necessarily have to do the mortgage with the builder to get the 7,500 any longer either, because they're not going to want to, they want to close homes. So, with that being said, this came out a couple of days ago on September 9th. And Brent, talk about this, because there's a difference in a direct lender and a mortgage broker.
There is. We, on our channel, Lee, we just put out a video here this week. The difference between a mortgage bank and or a
What
bank.
are you saying, Brent? Tell people to go to your YouTube channel and watch your videos, right? So
That's
Unitas Lending, right?
Unitas Lending on YouTube. Yep. Unitas Lending.
Right. They can put in your name too, because they can get it.
Yeah, probably find it that way too. Yeah, it's there is quite a big difference, because a bank is tied to their programs, their underwriting criteria, their interest rate sheets, that type of thing. And banks, if you walk into a bank, you're going to see multiple layers of management. You're going to see, retail space. If you look at the retail space, prime real estate sitting on the corners in major metropolitan areas with marble, counters and chandeliers, that type of thing. So they've got a lot of overhead that, a mortgage broker just doesn't have. And so we're able to compete on rate. And that's the number one thing. The question I get a lot, Lee, is, aren't you a middleman? Well, what we do is we do all the things that they do in those retail branches in a modest office, and then we sell the whole investment to Fannie Mae, Freddie Mac buys most of those loans, and a wholesale lender puts those and securitizes them and sells them into that market. So it's a much more efficient thing. A lot of the big banks, the big box banks, the Wells Fargo's, they're pretty much. They were determined to be the number one mortgage lender in the country. Oh, there it is. Yeah.
There's their site, man.
That's it. We got the market minute coming up every other day. We put, a market minute just to, hey, what's going on in the market, where rates are headed. Should you lock or float your interest rate, and why? That comes out Monday, Wednesdays, and Fridays. And we're doing lessons in lending. So we're going to cover all the basics of borrowing for a home, and how it's done, and how to get the best interest rate possible, and some tips and on how to do that. And then we're going to have some folks on. So Lee, I hope to have you on our show here soon.
Yeah.
So
definitely
it'll be good. Yeah, but there's a lot of just for options and how we compete. That's how we do it. We don't have any credit overlays. So if you have an issue with your credit, there's ways to get past that, and through that, and get those things corrected. And, so there's a lot of different routes that we have that a bank doesn't have. So that's really those are some of the main differences. And closing quickly, we're closing in less than 30 days. A lot of banks are backed up, and they're laying people off right now. We're growing, and they're cutting back because they've got that overhead to watch out for. So
if you go to my site right now, then at the bottom of it, there's a link to Brent right here. So you get that link, and it takes takes you right over to his site.
Oh, that's great. I appreciate you putting that down there, Lee. It's kind of you.
Well, what am I going to do without you?
That's right.
To go to
likewise, brother. Likewise. It's been a great run. We have. I love working with you.
Yeah, market's moving. So let's get into what's happening in the market right now. So we have some August numbers we can go through. If anybody's interested in this, stay tuned, because here it is. So let's start with Port St. Lucie. So still in a seller's market, but not like we were. So medium home price, I hate talking about medium home price, but it's easy to, figure it out,
Track,
what track homes a little bit, but 360,000 and get you much in Port St. Lucie. So, but anyway, so home prices have gone up to almost 30% in the last 12 months. So this is year over year. This this is August numbers. So we're looking at a medium home price at $361,289. Homes available in July, we had 1,589. So we're seeing inventory creep up, but it's not really creeping up that much. I mean, we're just up a little bit. So so we're still low on inventory. I mean, and you got to figure this is including new construction. So there's just not enough inventory out there still. So this is going to keep upward pressure on the market. Number of homes sold. July, we had 378. August, we're seeing, I knew this was going to dip. But typically August is our worst month. So that is every year. It's our worst month. So September, the end of September, market starts coming back and then rolls right into the holiday and then slows down again in January, February, and then picks back up. So we had 116 homes were sold in Port St. Lucie under asking. So more than likely overpriced or homes that needed work, because people really want, if you're a seller out there and you're selling your home, you got to have something going for you, or you're going to have to drop your price now. So, I mean, people still with the rates as high as they are, buyers are wanting homes that they don't have to do a lot of upgrading on. 121 of the homes were sold at asking. 84 homes were sold over asking. And as long as that keeps happening, that means there's bidding wars, and we're going to see prices continue to rise. And then average time on the market, again, we saw that start to creep up. I can tell you with our listings, we're seeing them sit longer. I'm seeing listings sit, depending, especially in the, around here, they're sitting, 60 days, 80 days, 70 days. But, again, 237 homes were sold under 30 days. 78 homes were sold in 30 to 90 days, and 4 homes were sold over 90 days. So, we're still seeing, we're, within 60 days, stuff's leaving the market. It's not sitting that long, depending on where it is. I mean, Traditions in Port St. Lucie is sitting a lot longer than the scattered lots are, but I think that's just pricing right now. A lot of the homes in Tradition are overpriced, and people are still trying to get that money in there. I just don't see it happening. You're going to have to sell your home, and it's going to have to appraise unless you have something really super special. Martin County, we were in a kind of a neutral market, and then Martin County moved this month, so in August. So average medium home price there is $424,000. Again, not going to buy much for that, but that's the medium home price, which is up 18% from last year over year. And then number of homes for sale, we're seeing that tick up. Obviously, we're seeing more inventory on the market, which is good. Number of homes sold, 127 in July. August, we had 141, and that's where that changed. And 22 of those were sold over asking, so that's where the market's still on upward pressure. 24 homes were sold at asking, and 95 homes were sold under asking. So again, 2 things happening right now. Sellers are still overpricing, but I'm finding buyers are wanting to try to get a deal. And I will tell you that, I'm looking at, I'm comping homes out right now, and I'm seeing, if the home's overpriced, you're going to be able to get it down. But if it's at the, value, it's going to be hard to get the seller to come off of it, especially right now, because realtors that are, experienced and that been in the market more than 3 years know that, this is a kind of a downtime, and they're not gonna lower the price they're going to keep their seller prices up.
Right.
Average time sold was 22 days. So it's the same, really. It says a little down. So I guess I don't know how that worked, but 3 homes were sold over 90 days. So again, everything's selling within, 90 days. And
Mm-hmm.
then Palm Beach County, still in a seller's market. Again, average home price 411, medium home price 411,000, but you're in a townhome for that. A number of homes for sale 9,000. We have more inventory again. August we're at almost 10,000. July we're a little over 10,000 in August, and then number of homes sold went down, but we're still seeing 399 of those homes were sold over asking, 376 were sold at asking, 1,100 of them were sold under asking. So, what this tells me is we're experiencing a deceleration in the market, and people are taking their time now. And I never suggested anyone not do an inspection. We were getting obviously appraisal waivers, and if we could get an appraisal waiver, we didn't do an appraisal. And then if someone could, and then we did some appraisal gaps where they might pay 20 or 50,000 over what the asking price was. But the big deal was I never told anyone not to do an inspection.
Right.
I thought that's a terrible idea. So if that was something that the seller wanted to do, we backed out on our clients. But people were doing it, but now they're not. And now they're doing appraisals too.
So, we're seeing more of that and less appraisal waivers right now.
Right. So the market's starting to adjust itself. It's a deceleration in the market, but we'll see what happens for September and the end of September here and rolling into the fall selling season. I don't have a crystal ball, man, and I don't know what rates are going to do. If rates are at 6%, it's definitely going to put a pinch on the market, though.
Oh, it is. It is. I think we'll see what the data looks like in the next few days, and what consumer sentiment is. It's considered a moderate report, but I think really the mood of the consumer is going to be really important here. Because you can see it in the stock market. People are watching this stuff. I mean, it was on every news channel. I think our ears are more tuned to it, that type of thing in news, but it was pretty much everywhere. And so I think, there is concern out there. And I think, as people make these decisions, the most important thing is, what's their individual situation, what are their options? You know what I mean?
Right.
And I think, it's really individual.
Well, we're still seeing people I have a showing from, on our farm's house, from a guy down, he's in Coconut Creek, and he's coming up from Coconut Creek to be with his family. And he's a cash buyer though, because he's going to sell his home. And and if you own a home in Coconut Creek, you can come to buy anything you want in Jupiter. So I don't care what. And he's restored the whole house. It's an older home. He restored it. So, so
some of the situations
most of the buyers are, for this market are coming from down south up to get out of the traffic, or they're coming out of state into the state. So if you are a seller, you're okay. I mean, as long as your house is priced properly, you're going to be able to sell it, and you're going to get what it's worth. Because, my wife even said today, she says, I can't, this stuff just isn't worth it anymore. And my response to that is always compared to what? Right. It's not worth it compared to what? Right. And I see it. I mean, we've been in Jupiter for 35 years. I mean, come on, Brent. 8 years ago, we were selling homes in Port St. Lucie for $165,000 that are worth now $450,000.
That's right.
Homes that we were selling 4 years ago for 400 or 600. So it's like, PJ Verano. I just pulled a list of homes and sent it to a client. I mean, there's 3 in there for over $1 million, and on the resale. I mean,
Right.
that's Port St. Lucie, man.
Right.
And the same thing is happening in every market where you're seeing an influx of people coming into that market. I mean, Orlando, we're looking for a home for my son right now. And, you know, my wife, we pulled into this little area in Winter Garden, and they have these beautiful little townhomes along this strip mall with all the restaurants and a Starbucks there and everything.
Yeah.
And they have 2-car garages. And my wife says to me, she says, this would be great for Alex. And I'm like, yeah, it's $450,000 though for a townhome. She's like, no, it's not. And I pulled one up right there and showed her. I mean, so, the bottom of the market in Winter Garden now is probably 350 for a decent townhome. And so that market is like this market. You go to Jacksonville, you see the same thing. You go to Tampa, you see the same thing. And the further south you go, the more expensive it gets.
Yeah.
So it's compared to what?
Coming
and then
from
when
California.
you start talking to these people coming from California and Seattle and Portland and San Francisco and New York, New Jersey, it's a bargain for them. And especially if they're not retired and they're working and they're able to transfer their job down here, or they're able to work from home, they're coming down here. And I mean, you're paying 60% taxes on your income if you live in the city. You come down here, you get rid of the city tax, the state tax, and now you just have your federal tax. So, I mean, you're doing a lot better. I mean, you're talking about, some of the, especially Miami and South Florida, from Palm Beach County to Miami, these, hedge funds and brokerages and aviation companies. And, I was talking to a nurse here in Palm Beach Garden. A doctor here in Palm Beach Gardens, and she went and worked in Port St. Lucie at the hospital there. They're begging her now to come there and offering her money to move because she's looking to move now up to Port St. Lucie and live on the river because that hospital up there, nurses are making $100,000 or more in that hospital.
Yeah.
So there's jobs are here. The income is rising. And I think, and you can respond on this, is the problem we're having in the market right now is not only we have strong job reports, the whole country, right? The job reports are strong, but these employers in the states where, companies are moving, businesses are moving, jobs are moving, these companies are willing to pay more money to keep their employees from leaving.
Right.
So, and work with them. So if, rents are going up, and when they go to their employer and say, hey, look, I can't pay my mortgage, I can't pay my rent, then they're, because of expenses, they're giving them a raise. And this is a trend right now. So the Fed's really fighting. I mean, the federal government's putting money into the market still. You've got companies giving raises. There's still money in the market from COVID money. It's still in the market. It's still out there. And I think all of this stuff combined is it's really put, I don't know how they're going to get through it. I don't know how the Fed's going to get through it. We're in a really tight spot. And I think it's moved beyond oil now. I really do. I think it's other factors involved now. I think there's just too much money floating around out there.
You're right. You're exactly right.
So I'm of the opinion of a lot of really, really smart people that I listen to, that this could last for several years. We could see, us fighting this inflation for, 4 to 5 years.
Yeah. It's going to take time to sift through the economy. I mean, you add $4 trillion. That's a tremendous amount of money. I don't think people can really get their head around how much money that is. And so that's got to be sifted through.
Well, $1 million you can put in a briefcase. $1 billion you can't fit in your house.
Right.
It'll fill up an 18-wheeler trailer almost up.
Yeah.
And so $1 trillion, you can't even fathom it.
Right. So, well,
And they're
it's
throwing trillions around like it's water.
Yeah, well, it's 1,000 18-wheelers filled. Yeah, because
Right.
it's
And as
1,000
long
times
as this
more.
war keeps going on too, it's going to keep the inflation going, because that's inflationary, because where are those companies manufacturing those weapons? They're doing it here in the US. So the weapons manufacturers are selling these weapons to the government, and the government's shipping the weapons over to fight this war with Ukraine. So, so I think that the Florida market is a, as a whole, is a good place to be right now.
Oh yeah.
I mean, it's a good place for jobs. It's a good place to live. And, but I think, it's unfortunate. It's going to be a tough ride for a while for all of us.
Yeah, it is going to be tough. And I feel, the middle class is getting pinched. There's no question. I think the impetus for a lot of people to move here, frankly, is because they're getting priced out of, the Northeast and then California and, those Seattle. And it's just, Chicago, it's
right.
You know what I mean? Because they're burdened with all those taxes they have to pay. And it's like, hey, I didn't want to move yet. I was waiting until I retired. Now I can work from home, or, every
Well, I mean, COVID changed the landscape because people are working from home. I mean, I have so many of my friends now, and we have so many clients that are working from home.
Yeah. So, how many traveling nurses,
speaking of working from home. So I need to follow up.
You need to get to work tonight.
So anyway, look, with everything going on out there, and I say this to everyone all the time, but with a lot of people are getting the pinch right now, and so be kind to each other. Try to help your neighbor and do the best for others that you can right now, because it's a tough time. Give that $5 extra at the grocery store, for food drives, things like that. Go give your time up, and if you have time to do it, and try to pour into other people right now, because it's a tough road for a lot of people right now. And 40% of America right now is behind on their energy bills. And we're a real estate show, but we care about people, and if you know me long enough, I hate real estate, but I love people, and I love the fact that we're able to serve people and help them into a home. And if it wasn't for the big smiles that I see on their faces, and the thank yous, and the the warm reception we get from our clients, this would be not a business I would be in. So this channel's all about serving everyone we can, and and that's a great thing about it. So that's why we do it. Joseph, all these, Nicholas, we're glad to help you, people like you, and give you some advice and send you in the right direction. So never not send a comment, even if you're not doing business with us, because we're out to help you. But if you are looking to buy real estate or sell, and you have any referrals and you're on our channel, please send them our way, because we're out here hitting it every day, and we appreciate the referrals, and we would love to help you sell your home or find a new home. And Brent would love to do your mortgage, and he does an awesome job. And so that'll wrap it up, I think, for tonight. If you haven't subscribed to our channel, don't forget to slap that subscribe button, ring that notification bell, so you don't miss any of our real estate tips and tours. And also, please give us a thumbs up. It helps the algorithm, and we really appreciate it, and other people get to see us. And we really appreciate all of you on tonight and all of your great questions. It was a good show tonight, and a lot of good questions. And we'll see you next Wednesday night at 7:00. Brent, you got anything to say?
You nailed it. That's great. Yeah.
All right, brother. All right. Thanks for coming on, everyone, and see you next week.